The information from the Bank of Canada indicates that a significant number of Canadian mortgage holders, particularly those with 5-year fixed-rate mortgages, will face increased monthly payments when they renew their loans in 2025 or 2026. 60% of renewing mortgage holders can expect an uptick, with many seeing increases of 15 to 20%. While some with variable-rate fixed-payment mortgages might see decreases, others could experience substantial hikes up to over 40% for 10% of renewing borrowers in 2026. The report suggests that borrowers' ability to manage these increases will vary depending on factors like principal payments made and income growth. Options like extending amortization periods or utilizing home equity lines of credit are presented as potential solutions, but the Bank of Canada acknowledges that some homeowners will still struggle to meet these higher payments. However, if the government has promised more affordable housing, how can mortgage payments be increasing so significantly? The core of the perceived broken promise lies in the contrast between a stated goal of affordable housing and the reality of rising housing costs, specifically mortgage payments. If the government's policies were effectively making housing more affordable, one would expect to see stability or even decreases in housing-related expenses for many, not significant. While the Bank of Canada is an independent entity setting interest rates, government policies, fiscal policy, housing supply initiatives, immigration targets, etc., can indirectly influence housing demand and supply, and thus prices and affordability. If the government's housing policies aren't keeping pace with market realities or are contributing to demand without sufficient supply, then housing costs can rise despite their stated goals. While interest rate decisions are made by the central bank to manage inflation, the broader economic context that necessitates such rate hikes can be influenced by government spending and fiscal policies. When housing costs rise significantly, especially for a large segment of the population, it naturally leads to public skepticism about government promises related to affordability. People directly experiencing financial strain from their housing costs are likely to view any government pledge on affordability as unfulfilled. The Bank of Canada report clearly outlines an impending increase in mortgage payments for a large number of Canadians, driven by rising interest rates. While the report doesn't comment on government policies, the perception of broken election promises regarding affordable housing would stem from the direct conflict between these rising costs and any government's stated commitment to making housing more affordable. For many Canadians, an increase of 15 to 20% or more in their largest monthly expense would directly contradict the idea of improved affordability, regardless of the precise mechanisms at play.